Welcome back traders to another exciting video on the AM Trading channel. In today's video, we will be discussing 3 of the best price action entry strategies that can help you grow your small trading account when you are just starting out. As a beginner trader, it can be overwhelming to try and navigate the complex world of trading, but with the right tools and strategies, you can set yourself up for success. In this video, we will be focusing on price action concepts and how they can help you identify potential trade entries in the forex and stock markets. So, let's dive in and discover the top 3 price action entry strategies that you should start using today. So, what exactly are supply and demand zones? Well, a supply zone is an area above where the price failed to break through and was rejected multiple times. From a price action perspective, market makers see this area as expensive, causing buyers to close their long positions and sellers to open their shorts. This double action creates a reversal in the price, making it drop from the supply area. On the other hand, a demand zone is an area below where the price failed to break through and was rejected multiple times. From a price action view, the market sees this as cheap, causing sellers to close their short positions and buyers to open their long positions. This double action creates a reversal in the price, making it rise from the demand area. Now, let's talk about some of the key supply and demand areas on the chart that we consider optimal trading zones. The first key level is the turning point. As you can see from this chart, the market was on a long-term downtrend until it reached this price, and the trend reversed. These are our traditional resistance levels, but what's important for us is this turning point, which the market considers very cheap. That's why we identify this level as extreme demand. If the price makes it to this level again, it might provide the perfect trading opportunity. Let's take a look at another chart example to further understand how price action works. As you can see, the price is constantly shifting between an uptrend and a downtrend, with minor swing levels in between which are considered to be support and resistance areas. However, the turning points in the chart are regarded as extreme supply and demand levels, providing the best trading opportunities. This is because the market identifies these levels as very cheap or expensive, making them crucial areas to monitor for potential trading entries. Moving on to the next topic, let's talk about major levels of market structure. A major level of structure is a zone that meets 3 specific conditions. It acts as both support and resistance, has been rejected multiple times, and has been recently respected. These zones can produce some of the most accurate trading entries. This chart shows a level where the price has been rejected many times in the past. It has acted as both support and resistance and has recently been respected again. Whenever the price reaches this level, we can expect the market to react to it in some way. We can see how many times the market has responded to this level in the past, and all we need to do is wait for a signal on a lower time frame to enter a trade, which we will talk about later in this video. Here's another example to help you understand this concept better. In this trade, we have 3 indicators pointing to a potential trade setup. First, we have a major level of structure, which suggests that the market may react to this price. Second, we have a bearish trend line, which could indicate a shift in the market's trend. Lastly, we have a candlestick that is strongly rejecting this level. All of these factors combined create a strong indication that the market may be primed for a reversal and may present a potential trading opportunity. It's important to remember that when several price action concepts converge in a specific area, it can create an ideal opportunity for high probability trades. As many traders are monitoring that area, they will likely take action when trading opportunities arise. Next, we have higher time frame key levels. Higher time frame key levels are an important aspect of price action trading. These levels are not always visible on lower time frames, but they can have a significant impact on price movement. When these levels are visible on higher time frames, they can provide high-quality trading opportunities. To incorporate these levels into your analysis, you can label the closest levels in front of the price as monthly levels on the monthly time frame. Then, adjust these levels based on the weekly levels on the weekly time frame, and adjust them again based on the daily candles on the daily time frame. This technique allows you to see the bigger picture and identify major levels of structure that can impact price movement on lower time frames. It's important to keep your charts as simple as possible, only including higher time frame levels if they are obvious and helpful to your analysis. When price taps into these monthly levels, they are not just ordinary supply and demand areas, but can potentially be reversal points for short-term trends on lower time frames. Now that we have discussed market structure, key levels, and price action concept, let me explain what setup we use to enter a trade. But before we do, please hit the like button and subscribe if you have enjoyed the video so far. So we have two kinds of price action setup: trend continuation and reversal. Let's begin by examining the trend continuation setup, specifically the double top and double bottom rejection pattern. The double top or bottom is a popular reversal pattern amongst price action traders. It takes the form of an M shape and is characterized by two rules for it to be considered valid. Firstly, the wick of the lower test must touch the body of the higher test, and secondly, the body of the higher test should not exceed the wick of the lower one. It is important to note that this trading setup is only effective in a trending market and should be avoided in a non-trending market. In order to execute this strategy, we must first identify the direction of the trend and wait for the market to make a valid double top in an uptrend or a double bottom in a downtrend. Now let's look at an example on this chart. The price is currently on an uptrend as price is creating higher high and higher low. Then the market made a double top and broke to the upside. In the next step, we will draw a line at the close of the highest candle and wait for the price to touch this line before executing our trade. We can enter the trade using various candlestick formations, such as long wick rejection or bullish engulfing patterns. However, in this scenario, we will enter the trade when a candle closes above the highest point of the previous candle. It is crucial to check the higher time frame to determine how much room the price has until it reaches the next level of market structure. For instance, if there is a monthly zone in front of the price, it could potentially shift to a head and shoulder pattern, resulting in a major trend change. Let's see another example. Here on this chart, we had a downtrend and then the market made a double bottom and broke it to the downside. So what we do is to draw a line on the close of the lowest candle of the double bottom pattern and wait for price to touch it. Then we will open a short position when the price prints a candle below the lowest point of the previous candle. Then place your stop slightly above the previous wick and target the next demand area. Moving forward, let us delve into the next price action setup, which is not only simple but also incredibly powerful. This setup is centered around the 61 Fibonacci retracement level. It is essential to note that this trading strategy is a trend continuation setup, and hence, it is crucial to utilize it when the trend is distinctly recognizable. Let us imagine that we are currently in an uptrend, and the market is continually forming higher highs and higher lows. The latest impulsive move commences from point A and terminates at point B, following which the market undergoes a pullback. At this juncture, we must ask ourselves the following question. Given that we are in an uptrend, what are the chances of the price retracing to point B before surpassing point A and prompting a significant trend reversal? The chances of this occurrence are relatively high. In light of this, we will approach this market as follows. We shall employ a Fibonacci retracement tool from point A to point B and precisely position a buying order at the 61 Fibonacci level. Our stop loss will be a few pips below point A, and we will aim to reach point B. This approach ensures that our risk-to-reward ratio is almost 1:3. To gain a better understanding, let us examine an example of this strategy. In this chart, we observe an apparent uptrend characterized by a sequence of impulsive and corrective moves. Here, we demonstrate how to apply the 61 Fibonacci retracement setup. Since our risk-to-reward ratio is 1:3, a single profitable trade can potentially eliminate 3 losing trades. It is important to note that while trend continuation trading setups boast a higher win rate, if you aim to make trades with an excellent risk-to-reward ratio, it is advisable to trade reversals. Without further ado, let us proceed to our critical reversal trading setup. When it comes to reversal trading, it can be a challenging endeavor. However, by utilizing a specific approach that incorporates higher time frame key levels with reversal patterns, it can be a fruitful endeavor. In this trading setup, two time frames are utilized, with the higher time frame being utilized to identify a major level of structure. As previously discussed, a major level of structure is a key level that has recently acted as both support and resistance multiple times. In the example provided, a 4-hour time frame is used to observe an uptrend, which results in a bullish bias. A major level of structure is identified in front of the market, and as the price approaches this level, it creates a short-term downtrend in lower time frames. The expectation is that the price will reject this area, so the 1-hour time frame is utilized to observe the price behavior once it arrives at the key zone. This enables a potential long position to be opened. When price reaches the key zone, only a double bottom pattern is required to signal a possible trend change for the short-term uptrend. A long position is opened on the second test as the market prints a bullish engulfing candlestick. The stop loss is placed slightly below the lowest point of the swing low, and the profit target is set at the next level of structure in the higher time frame. This approach allows for a high risk to reward ratio, with the potential for significant gains. In conclusion, we have discussed some powerful price action trading setups that can help you identify potential opportunities in the market. By combining these setups with proper risk management and discipline, you can improve your chances of success in trading. However, it is important to note that these strategies should be used as a guide, and it is ultimately up to you to do your own research and analysis before making any trades. Remember to always trade with a clear plan and mindset, and to continually adapt and learn as you go. Thank you for watching, and if you find this video helpful, please drop us a like, subscribe, and we will see you on the next episode.